The purpose of this video is to provide a brief explanation of what could be the single best way to guarantee your financial security for the rest of your life. As baby boomers continue to retire at a rate of 7,000 per day, the tax deferral advantages of a 401k, 403b, IRA, SEP, or Simple will become disadvantages. Not only do these plans force you to pay taxes on contributions and gains, but for many, it will mean paying those taxes 10, 20, or 30 years from now out of monthly retirement income when rates are likely to be much higher. Also, most of us will have fewer tax deductions in retirement, and the money you withdraw from your tax-deferred retirement plan will be considered income when determining if you pay taxes on your Social Security benefits. However, you do have an alternative. IRS tax codes Section 101 and 7702 allow you to earn interest on your savings without taxation and withdraw income from your savings without taxation. Unlike a 401k, 403b, or IRA, these provisions also allow you to withdraw funds tax-free before age 60 through tax-free loans that you pay back into your own savings. Another key advantage of this savings vehicle is the ability to participate in stock market gains without participating in stock market losses. This is a relatively new product, and it comes on the heels of the phenomenal success of fixed indexed annuities with over $123 billion in sales so far. Just like a fixed indexed annuity, when the underlying index, like the S&P 500, increases, you receive part of the gains. However, when the underlying index decreases, you receive none of the losses. For a more detailed explanation, please view the video entitled, "How Does a Fixed Indexed Annuity Work?" Let's take a few minutes to look at an example of how this new product, an equity indexed universal life policy, works. In this example, you are putting money into a universal life policy. Before the money even gets to the policy, a small portion comes out for fees and expenses, just like any other financial product. However, the rest of the money goes into the universal life cash value, which is represented by the dark blue box with the dollar sign. Then systematically, the insurance company pulls out the amount of money it needs to pay the death benefit costs, just like term insurance. The small blue box represents the minimum amount the company says you have to put in to be able to purchase the policy. However, there is a bigger box, and that's the dotted box. This box represents the maximum amount the IRS says you're allowed to put into the policy. And generally, anytime the IRS limits what you can put into something, it's usually because it's really a good deal. Many of you looking at this diagram will have two questions. The first will be, well, where does the income tax-free retirement come into play? And the second will be, what if I don't want life insurance? Why should I pay for a death benefit I don't want? Let's start with a tax-free income. The difference between the small dark blue box and the larger dotted box is your accumulated cash value in the policy. If you withdrew any of that money, it would be taxed as ordinary income. However, the insurance company allows you to borrow against that money at what is, in effect, a 0 to 1% loan. Because it is a loan, you do not have to pay income tax on the borrowed money. The loan is paid back at the time of death. However, because you are borrowing against the cash value only, the death benefit is still at full value and passes to your beneficiary income tax-free with no restrictions, no required minimum distributions, and bypasses probate and wills. Oftentimes, $1 of tax-deferred money can purchase between $2 and $4 worth of tax-free permanent life insurance for your beneficiaries. So not only have you provided yourself with an income tax-free retirement, your beneficiaries will receive 2 to 4 times the amount they would have received had you not purchased the life insurance. Plus, they will not have to pay income tax on the money they receive, unlike an IRA. Let's look at our second question. Why would anyone pay for a death benefit they don't want? The reality is the life insurance policy is a financial vehicle to achieve a goal, just like a 401k is a financial vehicle to achieve a goal. And all financial vehicles have fees, the difference being how large they are and what you receive in exchange for the fee. Typically, an insurance policy will have less fees than a 401k plan. And unlike a 401k, with an insurance policy, you get something in return for the fee you pay, meaning the death benefit. If I have to pay a fee, I would prefer to get something for my money. You're also forcing the money to work twice as hard. providing a retirement income and a death benefit. To learn more about the true cost and the hidden fees of 401k plans, go to the additional links section of thebetterwaytoretire.com and watch the 60 Minutes video, The 401k Fallout. You can also read the GAO report calling for better reporting on 401k fees. The reality is, most Americans do not have as much life insurance as they would like or need. Why not use the money that would have gone to pay the 401k plan fees to provide your family with the protection you would like them to have? Well, who is this type of program best suited for? It will work for anyone, and with the ability to now link to gains in the market, everyone should consider putting at least 5% of their income into one of these programs. However, they can be especially well suited for physicians, dentists, business owners, high-income earners, and those over 65 with funds in a tax-deferred retirement plan, like an IRA or 401k, that is earmarked for inheritance. If you have funds in a tax-deferred plan earmarked for inheritance, when you die, your beneficiaries will have to take required minimum distributions, starting in the first year of inheritance, for the rest of their lives. They will also be required to pay taxes on those distributions at current tax rates. However, if their inheritance from you comes in the form of a life insurance policy, there is no restrictions as to when they can use the money, and they receive it income tax-free. This program can be especially effective for business owners. That's because most small business owners do not have a lot of retirement plan options, and most of the options available require employee participation. Many small business owners would love nothing better than to fund an employee retirement plan. Unfortunately, the funds are simply not available. Since life insurance is not considered as a tax-qualified plan, according to the IRS, there is no requirement for the business owner to fund a similar plan for his or her employees. However, there is a second, more important reason why this type of program is especially effective for business owners. Many small business owners reinvest everything back into the business, and selling the business at some point, in effect, is their retirement plan. Once a business owner sells the business, where can he or she put the proceeds that will provide a tax-favored status? He can't use a tax-qualified retirement plan, a pension plan, or a profit-sharing plan, or even a Roth IRA, because each of these plans have contribution limits, and if the contribution is not deposited in the current year in which it is offered, then it is lost. None of these plans is adequately suited to receive a large sum of money that could arise from the eventual sale of a business. However, life insurance not only provides a completely flexible plan in which the business owner can vary deposit amounts from year to year, it also allows the business owner to make up for previous missed contributions if cash flows improve in the future. Let's say the maximum contribution allowed in the insurance policy is $5,000 a year, but the business owner only deposits $1,000. With a Roth IRA, the other $4,000 opportunity is lost. But with a life insurance policy, the $4,000 opportunity carries over into the next year. As a result, it can be structured to create a bucket big enough to hold some, most, or all of the proceeds from the eventual sale of the business. This allows the business owner to put their sale proceeds to work in a tax-favored manner, while at the same time providing a tax-free inheritance for their loved ones. As a nation, we are about to go through radical financial changes, and you will need strategies that will protect you from higher taxes and lower benefits. I have the strategies that can protect you from loss and give you the opportunity to thrive with minimal risk during these difficult times. However, time is of the essence. These issues are fast approaching, and action must be taken soon. Every day you wait, 7,000 more baby boomers turn 65. Call 856-887-1887 today and ask for your free report comparing a tax-qualified plan, a Roth IRA, and an equity indexed universal life policy.